Hey guys, it's Andrew Henderson from nomadcapitalist.com in Kuala Lumpur, Malaysia, and I wanted to do a little Nomad Capitalist 101 today, talk about a topic that's really important but also really misunderstood, and one that we've talked about for years, but that there is still a lot of confusion and a lot of misunderstandings surrounding, and that is in the world of tax. What is the difference between a citizenship-based tax country, a residential tax country, and a territorial tax country? These are the three types of taxation that a country can have, other than, of course, zero tax. We've done a video on that where I reported from Kuwait and talked about the different zero tax countries where they don't tax income, either at the personal and or corporate level. Obviously, if there's zero tax, then you don't really need to worry too much about it. But for the rest of the countries that have tax, how do you determine the type of tax that your country has or the country that you want to go to or spend time in? And so let's start with the least common type, but the type that probably affects a lot of viewers of this video, and that is citizenship-based taxation. Two countries on earth effectively have this. They are the United States and Eritrea. Eritrea being a tiny war-torn country in Africa next to Djibouti and Yemen and Ethiopia. Yeah, still don't know? Yeah. This is a country that has a 2% tax on its diaspora, people living overseas. A lot of Eritreans living in San Diego, for example, and they're supposed to pay this 2% tax on their worldwide income. So it's not full income tax rates, and seeing that Eritrea is not so well connected as the North Korea of Africa into the global financial system, it's kind of difficult for them to enforce, other than perhaps not renewing passports. The other country, of course, is the United States. And the United States gave its citizenship-based taxation more teeth under the Trump tax reform of late 2017, where now, even if you live overseas, even more types of income will not be exempt from tax. So essentially, the United States is taxing its citizens on a worldwide level with even fewer ways to get out of paying that tax. Passive income, for example, earned by U.S. citizens is basically taxed with no exemptions no matter where you live in the world, and active businesses are now taxed with fewer exemptions than they had before. So the United States, if you're a U.S. citizen, you not only have to report your bank accounts, report your corporations, file a tax return, no matter where you live. Some people still don't understand that. Even if you live in a tax treaty country, you have to. And that the U.S. will require you to. And of course, they're a bit more well-connected than Eritrea is, and so they can pretty well enforce that. We did a separate video on how if you owe $50,000 or more, the IRS can cancel your existing passport or refuse to issue you a new one via the State Department. So basically, if you're a U.S. citizen, you're going to pay no matter where you live. There are some exemptions. That's obviously what I help folks with. But they are a bit more difficult and a bit more harder to understand than they used to be. So if you live in one of those two countries, or rather you're a citizen of one of those two countries, you've got obligations no matter where you go. Now, the most common form of taxation for the rest of our viewers and for just most people who are on YouTube is residential-based taxation. This is basically what it says: if you live in a country, you pay tax there. If you don't live in a country, you don't pay tax there. And there are a whole set of rules for determining where you're deemed a resident. What it used to be before the era of digital nomads and what have you was a lot of tax offices were somewhat lenient. Okay, as long as you're not living here, we don't enforce that many restrictions. Now that we have people bebopping all over the place, they're really getting strict on what determines a resident. Sometimes just having a driver's license can make you a resident. Sometimes being registered to vote can make you a resident. Sometimes, owning a house or keeping your apartment lease or countless other things can keep you a resident. So the old school of just leaving the country and not doing much else no longer works. That said, for pretty much every country in Western Europe, Canada, Australia, New Zealand, Israel, all the developed countries in the world, and I imagine the less developed countries that I have less knowledge about, you can simply move out of the country and go and live somewhere else. There are some kind of weird exclusions where, for example, a French citizen can't go to Monaco and avail themselves of Monaco's zero tax policy. That's a carve-out that was established about 60 years ago. But French citizens can't go anywhere else. They can go to Dubai and not pay tax. So there are some weird carve-outs to be aware of. There are some restrictions that you have to follow when you're leaving the country, but generally you can leave the country and then you can choose where to go. And so obviously a lot of Brits or other expats will go to other developed countries and pay a lot of tax. But if you're living the nomad capitalist lifestyle, you can leave your residential tax system and then go find a zero tax or a territorial tax country to live in and pay a lot less. And so that brings me to territorial tax. What is territorial tax? There are some misunderstandings around this. Territorial tax is, in my opinion, the friendliest system for tax outside of zero tax. And what territorial tax means is essentially this. If you earn money in our territory, you pay tax. If you don't earn it here, you don't pay tax. What that means is a lot of these wealthy expats who go and live in Singapore, which has a territorial tax system, can exempt from tax a lot of their foreign investments. Now, those foreign investments may be taxed in another country. For example, if you go to live in Singapore, you would never be asked to pay tax on your rental property in the United States. Of course, that rental property is deriving income that is taxable in the United States because it's rental property on their soil. So it doesn't necessarily mean you pay no tax on all foreign income because it depends on where the foreign income is. But if your operating investments, such as stocks, for example, that may not be taxed at the source, if you have other investments, gold, interest income, cryptocurrency, perhaps, whatever, if they are overseas, those investments may be tax exempt. Basically, a country like a Singapore or Malaysia or a Georgia or many others would only tax you on income that you earn there, so salaries, rental incomes, etc. The one challenge where people sometimes get a bit confused is in some territorial countries, and really it's more of a matter of enforcement. You may have to pay tax on a salary that you earn while doing the work in the country, even if it's paid overseas. And that's not the case in all these countries. But sometimes people will go and live in a country for the whole year. And that's a territorial tax country, and they'll have their offshore company in a different country, and then they'll have the offshore company pay them a salary into a bank account in a different country, and they'll say, hey, the income's not being sent to this country I'm living in. Territorial tax system, I owe nothing. Generally speaking, correct. However, in some countries, they'll say, well, hold on. Yeah, it's territorial, but you're here, and you're doing your work here. So now we get into the issue of a whole bunch of controlled foreign corporation laws, if those exist. We get into an issue of, what's the tax nexus of having an agent of that company in the country. At the very least, perhaps your salary is subject to tax. So just because it's territorial tax doesn't mean you can just go and work there for your entire life and not pay tax. In some cases, you can. In some cases, they don't care. But in other cases, and it's just worth considering, if you're staying somewhere and signing contracts and doing deals in another country, that may invalidate in some cases the territorial tax because, again, the territory you're doing the work that you're being paid for is in their country. It's not really offshore at that point. And again, there are plenty of exceptions or exemptions around that, but something to keep in mind. So obviously, if you are from a zero tax country like Monaco, you can go anywhere in the world that you want, and as long as you don't become a tax resident, you're not going to have any problems. For the rest of us, it's a matter of basically getting out of our home country's system. If you're a U.S. citizen, you can get certain exemptions by living overseas, and it's become a lot more complicated in recent months. If you're a citizen of other Western countries that have residential tax systems, it's a matter of getting out of that country the right way. And again, I've done numerous videos on what I call the Nomad tax trap, where people think that they're non-residents and they're actually later deemed to be residents, so it's important to do that correctly. But the point is, if you can get out of your residential-based tax system and go to a zero tax country or go to a territorial tax country that's not going to bother you, or if you're a U.S. citizen and you're willing to pay some tax but less, or if you're a U.S. citizen who's willing to renounce your citizenship, that's how you get down to zero. And people think they have to live in a zero tax country. You potentially can live in a territorial tax country, or you can be nomadic and follow my trifecta model and live in a couple different places and not trigger tax residency in any. Again, becoming a bit more difficult for some people. But there's a lot of different models out there. That's an introduction to the three types of taxation. It's important that you at least understand what they are and what the restrictions are, and understand what your country is. A lot of people think that, because they live in Ireland, which taxes their worldwide income when they're a resident, that Ireland has worldwide citizenship-based tax. That's not correct. If you're living in Ireland, once you leave Ireland, you no longer pay tax to Ireland except that Irish source income. So it's not the same thing. People oftentimes get it confused. The question is, can I escape this tax system and how? For U.S. citizens, you get a limited number of exemptions, and after that, you have to renounce. For everyone else, it's a bit easier, but you still have to follow some rules. If you want to find out more about tax for nomads and the nomad capitalist lifestyle, definitely subscribe to our channel and visit nomadcapitalist.com with over 1,300 articles for you to peruse at nomadcapitalist.com.